Welcome to Chapter 3, the meat and potatoes of IAS1. Here we're not talking about theory, but about structure. What exactly makes up a complete set of IFRS financial statements? It's like a recipe. If even one ingredient is missing, it's not a proper IFRS meal. So let's break down the required components one by one and understand what role each one plays. Here's what we want to achieve in this chapter. First, you'll be able to name and describe all components of a full IFRS compliant financial statement set. Second, you'll understand the purpose behind each of those statements, what questions they help answer. And finally, we'll clarify the difference between profit or loss and other comprehensive income. A classic exam trap and a real-life reporting headache. Let's get into it. According to IAS 1.10, a complete set of financial statements includes 6 parts. 1. The statement of financial position, also called the balance sheet. 2. The statement of profit or loss and other comprehensive income. 3. The statement of changes in equity. 4. The statement of cash flows. 5. The notes to the financial statements. 6. And of course, comparative information, usually for the prior year. This combination gives users a full 360-degree view of the entity's financial story, from what it owns to how it performs and how it communicates key assumptions. Let's start with the statement of financial position, the classic car balance sheet. This is a snapshot at the end of the reporting period. It shows what the company owns, assets, what it owes, liabilities, and what's left for shareholders, equity. One key rule, IAS 1 requires you to classify assets and liabilities into current and non-current, unless a liquidity-based format is more relevant, which is sometimes the case for banks or insurers. The goal? Show financial position clearly and comparably, year after year. Now let's move to performance. Then the statement of profit or loss and other comprehensive income is where we see how the business performed during the period. It has 2 main sections. First, profit or loss, the traditional income statement, then other comprehensive income, or OCI for short. IAS 1 allows you to present these either as a single combined statement, or 2 separate statements. Either way, users need to see both pieces to understand total performance. Here is where the students and honestly even companies often get tripped up. So what's the difference between profit or loss and OCI? Profit or loss includes revenue and expenses from regular operations, finance costs, taxes, and discontinued operations. This is the number most people focus on, the so-called bottom line. OCI, on the other hand, includes items that don't go through profit or loss, like revaluation gains on assets under IAS 16, foreign currency translation. Differences under IAS 21, fair value changes on certain equity investments, IFRS 9, actuarial gains or losses from pensions, IAS 19. Some OCI items may be reclassified to P&L in future periods, others will never be. That distinction matters and should be clearly presented. This is a super important statement, even though it often gets less attention. The PUN statement of changes in equity shows all movements in equity during the period. It tracks profit and loss, OCI, dividends paid, capital increases, adjustments from changes in accounting policies, or error corrections. It gives insight into how equity evolved and where those changes came from. In short, it's the equity story of the year. Yes, cash flow. Everyone loves it. Even though the section statement of cash flows is defined in SECI 7, IAS 1 still requires its inclusion. It shows actual movements of cash and cash equivalents, broken down into operating activities, investing activities, financing activities. It's often seen as the most intuitive statement because it's about real-world inflows and outflows, but it also needs careful interpretation, cash profit. Now we arrive at the notes, but don't be fooled by the name. These are not optional footnotes. The notes explain the accounting policies used, the assumptions and estimates made, breakdowns of line items from the main statements, risks, contingencies, related parties, and more. Without the notes, the numbers in the statements are just headlines. The notes give you the full story, and they're critical for transparency. A core principle of IAS 1 is comparability. That's why you must show at least one prior period, let's say, alongside the current one for every statement. Users need to see trends, changes, and consistency. And if figures from the prior year have been restated, that must be disclosed with an explanation, usually under IAS 8. This is not a nice to have. It's required and central to the usefulness of the financial statements.